Good evening. This is the India Development Debate right here on ET Now. I'm Supriya Shrinate, and straight up to a big story that we are tracking right here, which is Indian market. But coming up at 9:30 p.m. is also an event that is going to decide what markets will be up to, and that's the political. It's a Maha jolt for the Congress coming in from none other than Mayawati. The Gathbandhan Maya is what we are calling it, and that's coming up at 9:30 p.m. this evening. Thank you very, very much for joining us on this edition of the India Development Debate. It's a star-studded panel as far as the Indian markets and the macroeconomy is concerned. KK Mistry, Vice Chairman and CEO of HDFC, joins us right here. Saurabh Mukherjee, Founder, Marcellus Investment Manager, is here with us. Ajay Srivastava, CEO, Dimensions Consulting, and our consulting editor, Maithili Bhusnurmat, as well, is here with us. So thanks each one of you for being with us. And Mr. Mistry, if I may begin with you, and the question I think that many people need to know today is an intraday swing of 1,500 points for our markets, 1,000 point crash at one point in time. I know the trigger perhaps was a bond buy, but the question is, there seems to be this fear that's gripping the Dalal Street. There seems to be this concern, this fear factor that's on the markets, that's plaguing our markets. What is that concern, Mr. Mistry?
My sense is the nervousness that the market has been facing for the last few days, apart from the currency and everything else, revolves around the lack of liquidity in the system. So liquidity has been low for a while. One of the papers of one of the companies was sold today in the market at a much higher yield than the market expected, and that caused panic. And I think that panic, so people sort of overreacted to the panic, and that overreaction is what we saw reflected in market performances today, with stocks going all over the place. So I think fundamentals have not changed. There is nothing that is fundamentally wrong in the economy. There is no imminent risk of any major default happening other than whatever one has heard of IL&FS. But other than that, there is no risk of any paper getting significantly downgraded or anything of that sort. So I think it's a knee-jerk reaction of the market based on the sheer fact that one of the company's paper was traded at a much higher yield than what the market was expecting.
Okay, Saurabh Mukherjee, if I may come to you, the fear factor is that, you know, there's this one paper that was sold. Is that what was the big trigger? DSP Mutual Fund did sell DHFL at a discount of 11% in the bond market. But my question is our market so fragile that it dipped 1,000 points then and then an intraday swing of 1,500 points? I mean, are our markets so weak? If the fundamentals are as strong as, you know, most of you insist it is, then can fear be, I mean, fear cause such knee-jerk reactions?
I think, Supriya, I think KK Mistry captured the triggers that affected the market today, I think, very nicely. I don't think there's much to add there. But I think the bigger challenge is we have a financial system with NBFCs, HFCs and wholesale funded banks trading at what have to be said as are ridiculous valuations. By definition, NBFCs and housing finance companies borrow money in the wholesale market, 3 month, 6 month, 12-month money, and they lend that money 3 years in the case of an NBFC and sometimes 20 years in the case of a housing finance company. That's called maturity transformation. You're borrowing money short term, you're lending it long term. No investor in his right mind gives them the sorts of valuations the Indian market's been given these sorts of lenders for the last 12 months. These are overvalued lenders. A correction was long overdue, and I think we're just beginning the process. We're beginning the process of correcting this massive overvaluation in wholesale funded lenders in the Indian market. The specific triggers will change from day to day. Something's happened this week, something else will happen next week, but this correction is long overdue in wholesale funded lenders, whether they be banks or NBFCs, and the process has begun. I reckon it will continue for the next few months.
Okay, so that's a sound sort of an assessment coming in that this is the froth that is being corrected, and this is long overdue. But Ajay, if I may ask you, Mr. Keki Mistry did mention liquidity situation tightening for a section of the market. I mean, how wary are you personally of this happening in the markets, and what is this going to really do to lending at large? I mean, lending, whether it's by the housing finance companies or by NBFCs, if liquidity does tighten, how is this going to impact lending and their businesses?
I think Mr. Mistry obviously has calmed the nerves on the program, but I would tell you there is two different universe. It's the universe of the top 3 or 4 institutions in the country, and the rest of the universe belongs to the smaller companies, the mid caps, and all the NBFCs put together. They work in absolutely 2 different environments altogether. And I think let's recognize the reality today. It's not about overvaluation of NBFCs. What we have seen today, and I'm not over-exaggerating, is literally a Lehman moment for IL&FS. The credit market is getting more and more gridlocked. We saw in the evening, people want to get out, they can't get out of the papers. Commercial paper was getting illiquid in the evening as the market closed. Luckily, it's a weekend. And, I would fervently hope that just the way the weekend of October 3rd, 2008 was used to unroll tap, government or RBI needs to come around and offer a liquidity window to this paper which is floating in the market. And that's the first thing. Number 2 is, it's a combination. You saw it all started with Yes Bank. We all had a good sunny morning, 100 points up, only Yes Bank down. It all started Yes Bank. That's not the right way. I'm sorry to say this. The regulator cannot take a bank's chairman and, put him out of the equation just by a missive without telling the market that what were the grave offenses at which he was asked not to, his extension was not approved. That's a great signal to the market that is something very big amiss, because obviously RBI rejecting a CMD, I can't even imagine when that last happened. It's unprecedented. One would expect it that if they were not willing to give Rana Kapoor an extension, they would have told him, don't file an application, we don't think we're going to give it to you, handle it calmly. We have a 25,000 crore carnage on that one line missive without telling us what is the crime of Mr. Kapoor, what's happened inside the balance sheet Yes Bank. So it's a combination, credit, Yes Bank, RBI, then the new SEBI diktat might come on the net worth of investors who can come in the futures market. So it's all a combination. It's not like one thing called NBFC valuation. It's a combination hitting and hitting very large, the sector just below the AAA rated like HDFC Twins.
Okay, Ajay, the reason why I think it's important to address this point right here before I go to IL&FS also is that we put out a story right here at TT Now which said that RBI in its letter to the board of Yes Bank said their governance lapses, the compliance culture is very weak, and asset recognition is again incorrect and wrong. So it's important to point that out. But by the same logic, Shikha Sharma, yes, she was not a founder promoter, but she was also asked to cut her tenure short. Having said that, Maithili, I'm going to come to you, or if I can take a quick question from Keki Mistry and then come to you, Maithili. The question really, Mr. Mistry, is on IL&FS. It defaulted multiple times in the last 2 weeks. It is, it's got some of the largest investors of the government like LIC or SBI, NHAI owes it some money, 16,000 crore rupees. What do you make of this situation? I mean, many people are calling it the ticking time bomb.
Well, I'm not conversant with specific reference to any company, whether it's IL&FS or anyone else, so I won't be able to comment on the balance sheet. But I'm sure IL&FS has got assets. The problem is the liabilities may be maturing at a faster pace. The assets may be less liquid, and therefore it might be a little more difficult for them to dispose of the assets. If they were able to find a way of tiding over the short-term problems, and if they would manage to roll over some of the liabilities, then I think some of these problems will get mitigated. But currently, obviously, there will be an issue because their assets are long-term, and it's obviously not easy to sell off a road asset or sell off one of these infrastructure assets. It takes a while to do it. Whereas the liabilities, when they mature, they have to be paid back on that day. So if they can find a way of rolling over those liabilities, then they could still be able to save the day.
In fact, IL&FS defaulted on the IDBI exposure today, and they've defaulted multiple times in the last 2 weeks. Maitri, I want you to take this question because I know you've been doing special shows on this. You've been speaking to people, and you have a greater sense of this. And then I'll go to both Saurabh and Ajay Srivastav on IL&FS for a minute, because moments before I started this show, the MD and CEO of IL&FS Financial Services, Mr. Bawa, has resigned. You know, Ajay says this is a Lehman-like moment as far as IL&FS is concerned. I'm given to understand huge exposure in public sector lending. How grave is the situation at IL&FS? And, you know, have our regulators and government at one level deterred decision making at IL&FS, and which is why we've landed in this situation?
Well, IL&FS is a big problem because it has a 90,000 crore debt on its balance sheets overall, including that of its subsidiaries, and it is a reflection of a failure on multiple fronts. That is the regulator, which is Reserve Bank of India, rating agencies, which as always have been found napping, you know, locking the stable doors after the horses bolted. Because remember, till not very long ago, IL&FS was a AAA rated company. So you have a failure of rating agencies, you have the failure of the auditors, and most of all, Supriya, a failure of corporate governance, because here you had a star-studded board of directors on the board of IL&FS, and nobody seems to have raised any alarm. You had one CEO who was serving for almost 30 years. So as with many of our other financial institutions, you have the problem of one regulator and one CEO who seems to have such a completely captive board of directors. So nobody raises any questions at all. So IL&FS is a big issue, but it's not a publicly owned company, in the sense it is not majority publicly owned. So I think here the regulator, the Reserve Bank of India, will have to take a call, because even though it's a systemically important core investment company, should you allow it to go down, or should you bail it out? And why should you bail out essentially a private company with taxpayer money? That really is the big call that the regulator will have to take. I think today's problems were driven essentially because you had a large mutual fund selling off the shares of another NBFC at a huge discount, because it was worried about having liquidity problems thanks to its exposure to IL&FS. So it's a combination of factors, and I think this clearly shows that NBFCs or shadow banks need to be regulated far better. The rating agencies need to be kind of pulled up for what is clearly negligence on their part. So a failure on a number of fronts, including most importantly that of corporate governance.
Okay, very quickly then, I want to get Saurabh Mukherjee and Ajay Srivastav both into this debate on IL&FS. And you know, this is a failure on multiple fronts according to Maitri. The regulator failed to check in. The government hasn't taken a call on, you know, should you be given money to tide over this present situation? Why is NHAI not paying back money that is due to IL&FS? Ratings agencies, I mean, year after year you're giving it a AAA plus rating. Now only you've downgraded to AA plus. Ajay, to begin with you, because this is a governance failure, this is a regulatory failure of sorts, what is the way forward for IL&FS? Can we afford to let that, let that go down under?
At this point of time, on this weekend, that's why I reminded you of October 3rd, 2008. This time, this weekend, the government needs to take a quick call on IL&FS paper and says we offer a window for purchasing or line of liquidity to IL&FS. There is no other person who's going to lend to IL&FS except Government of India. LIC will have a longer process. It has to be simple, straightforward, bail out. At this point of time, I don't think so. We will ever have a situation of a 90,000 crore meltdown happening in the market and we surviving as an economy. The dominoes will be far reaching on this part of it. So I don't think there is much choices left, and I'm really hoping, and that's why I said it's all about timing. Once the damage is done, and then you come and put money into it and recover it, and maybe happening and so on and so forth, but the market damage is done. So maybe there is no alternative in my view but to bail out IL&FS, rest rating agencies. Mr. Parthasarthi having a good time with this company and walked away from it. The new CEO, I think, is less than a year old at this point of time, so can't blame the fellow. The board of directors, we know what the board is all about. You can see the names. They are the regular from Government of India, officials, LIC, etc. It's the same roster. Nothing you can do with them. You can't go take them to anywhere in any court in India by any standard. No government will do that. So I don't think there is a choice. You got to bail it out. Bail it out this weekend. So when market opens on Monday, you have a reassurance that the liquidity system in this economy is working. There is no gridlock which is coming out. What's emerging in today's market, let me tell you, is not about investors fretting about valuation. Is the credit gridlock coming and staring in the face. If 11% paper is being sold in the market, can you believe it? That goose is cooked. That company's goose is cooked, because to refinance, who is going to buy the paper? And if he's going to refinance at 11% plus, being a housing finance company, who does he lend to? That company's goose is cooked. We don't want to ensure that others' goose is not cooked on Monday, and I think credit gridlock needs to be carefully ensured that it doesn't happen on Monday onwards.
Fair point. Fair point. That's an important point that you make. But you know, Saurabh, I think on IL&FS, we will have to talk about the problems that it has faced as a company. IL&F perhaps reflects the issues that one faces in Indian infrastructure, the kind of concerns that one has faced, and is that what is reflective in how the, you know, how the whole thing is coming out? It is not just, you know, liquidity support from the government that will help it tide over. The government and the regulator obviously need to get their act together. Thankfully, it's a weekend, all said and done. But it is a clear reflection of the problems the sector faces. I mean, time and again. It has an exposure of 55,000 crore rupees to the public sector banks.
I think we are barking up the wrong tree. I think we're barking up the wrong tree here. I'm not denying IL&FS's problems, and I'm very confident. I'm very confident the authorities will do the needful over the weekend. But I think the finger of blame has to be pointed here at equity market fund managers. This movie, the movie that we are watching and in a way playing a role in, was played out almost identically through the UK, USA in 2007-8. Late 90s India, we saw a very similar movie. This movie plays out in every single country every 10 to 15 years when wholesale market funding costs rise, when the currency comes under pressure. Any sensible fund manager, there's dozens of books written about the Lehman crisis, there's half a dozen movies. Any sensible fund manager who was alive 10 years ago has no business holding so many HFCs, so many NBFCs, so many wholesale funded banks at these valuations in his or her books. The fact that Nifty banks or BankX, Sensex BankX accounts for 40% of the stock market's market cap is an indictment of our fund management system. I'm not disagreeing that IL&FS has issues. I'm confident the authorities will address that. But I think for a change, let's not bark at the government and say they failed on this, they failed on that. I think here we have to look at the fund managers in this country and say, what on earth are they doing? Why do they hold these papers at these ridiculous valuations in investors' portfolios? It really is something that needs to be looked at.
Okay, I think it's an important point that you're making, and I'm glad that you and Ajay are disagreeing. I love disagreements on my show, which is why we call it a debate and not a discussion there. But let me just turn the focus away for a minute from IL&FS and Yes Bank and, you know, what happened in immediate triggers to equity. And Mistry, there has to be the question on macros that will have to be asked. Whether it's a rupee that's been very volatile and depreciated, or a CAD that has widened, or fresh fiscal concerns that have emerged, especially given how Saudi Arabia wants oil at levels of $80 and not below. These are adding to concerns that are on the street. And add to that political concerns where, you know, the invincibility of this government looks a little tough now, assembly elections, new sort of alliances in states. Are these fresh concerns that are plaguing Indian markets, and are we also seeing some of that play out? Apart from, of course, what the globe is doing and the emerging market contagion and all of that. Too much for the markets to deal with.
Absolutely. There's a combination of many things. Markets don't become weak in 1 day or 2 days' time. It's a combination of the fact that oil prices have gone higher. There is fear that oil prices may go even higher. U.S. economy is doing well. So with a strong U.S. economy, there has become a lot of money is flowing back from emerging markets into developed markets, particularly into the U.S., making the dollar stronger. Stronger dollar is never good news for someone like India. Also, high oil prices is not good news for India, which in turn results in an increase in the current account deficit. But what we must recognize is as the rupee gets weaker, and with the rupee at 72, whatever the level is today, at those levels, exporters become much more. It sort of supports the exporters much more than what the support that the exporters were getting from the currency, say 6 months ago when the rupee was 65 rupees for a dollar. So exports would increase. If the exports increase, then naturally the trade balance will sort of improve. If the trade balance improves, then automatically you will find that the current account deficit will also come down. And if the current account deficit comes down, then that will be good for the rupee.
Okay, before I go forward, I will take this across to Maithili. And Maithili, on the macro concerns, of course, one is the macro economy concerns, and the other is an overhang of elections now. Going into the state assembly elections, already this whole Mahagathbandhan, Mayawati tying up with Ajit Jogi, and of course, the BJP versus the Congress in the 3 assembly elections, where it's reported that the BJP is looking weaker than the Congress. How much of a play will this all have going forward? I mean, will these be obvious concerns that will shroud markets, or eventually it's going to be about valuations, eventually it's going to be about policy and fiscal action, really?
Well, the overhang of elections is always important, and as we approach the elections, you will find that play out on the market. But today's developments had really nothing to do with our macros, Supriya, because our macros are still fundamentally unchanged and fundamentally sound. We had 2 big voices, both from JP Morgan and Morgan Stanley, express confidence in India. So today's developments were purely driven by the developments that happened relating to Yes Bank and also in relation to IL&FS. And while Yes Bank would be more a temporary thing, because after all he has built an institution, and presumably just the fact that he didn't get an extension will not be a permanent setback for Yes Bank. But IL&FS is a bigger worry, because there is the fear that dependence on wholesale funding and this entire talk that you could finance infrastructure through wholesale funding just will not work. So IL&FS could be the tip of the iceberg. So IL&FS fears are more important and will have to be addressed more immediately. Yes, elections matter, but today's developments had really nothing to do with macros. It was more micro triggers.
Okay, micro triggers there, but Ajay, Saurabh and Mr. Mistry will take a quick last question round, and please be brief on this. And Ajay, what is it that the markets fear when they fear politics? Yes, there are micro triggers, and I think those micro triggers will be taken care of by fiscal and policy actions, hopefully. But what is it that the micros fear when they fear politics? Do they fear the government turning populist? Do they fear uncertainty, discontinuity? I'm just curious to understand.
Not at all. If you talk to investors in our community, and I'm sure Mr. Mistry will test, I don't think so that's a big issue, because for an economy like India, what are the choices your government makes? The government makes exactly the same choices. If you look at the Congress regime, it's the same choices of funding the agriculture, funding the rural poor, doing what is required to be done, increasing your taxes for the middle class, and taxing more and more commodities like oil. The same thing government will do, the same if a new government comes will do the same thing. I don't think the priorities are any different. I think what we expect is a little more respect for the market and a little more coordination between the regulatory agencies. That's what is missing today, and that's what we expect to happen, so that, well, bad things are happening. Okay, oil has gone up, rupee has gone down, things are bad, but then other things which can impinge on the market, like liquidity, we said the stock market regulation by SEBI, for instance, those things, the way you handle a Yes Bank episode, you don't destroy 25,000 crores on the market cap, and the way you give the news to the market, or you come up and do it. I think those things bother more to us and to the community than just the fact that there might be a government change or there might be a coalition. Coalition has not been bad for Indian stock market, so I don't think that's a big worry. The big worry is immediate, which is all these factors that we spoke about, and having an environment which nurtures our equity culture and gives importance to stock market. That's the critical thing.
Okay. Okay, very quickly then, Saurabh Mukherjee and KK Mistry, quick last word. Then Saurabh, to you then. The retail investors have come back to the markets. When they see stocks tank by about 50-odd%, they're obviously wary. What would you advise them to do? I mean, I'm not really looking at stock tips, I'm just asking from a larger point of view.
I think investors, whether they be retail or institutional, I think they need to realize this is an overvalued market, especially significantly overvalued financial system. This is not the time to be buying financial stocks. But in a way, the least of our concerns next week will be the stock prices. I think, as other guests on the show have mentioned, there's a lot more at stake next week than the share prices of banks and NBFCs. And I think we all hope and pray that the regulator will sort that out over the weekend. But don't buy financial services stocks at these levels. It makes no sense at all.
Okay, if you're an investor, you'll have to listen to this. Don't buy financial services. What's the word coming in from Saurabh Mukherjee? But Mr. Mistry, retail investors wary at this point in time. What would your advice to them be?
See, I can speak from personal experience only, I'm not a market participant in that sense. But my personal experience shows that whenever markets are very weak, that is not a time to panic. That is a time to hold on to your investment, because whatever goes down on the long term comes back, unless you have invested in companies which are fundamentally not strong. If you've taken the risk of investing in companies which are not fundamentally strong, then that is a different issue altogether. But if you invested in fundamentally strong companies, then wait out this period. Maybe you could even use this as an opportunity to add a little bit to your investment, because when markets are down with a long-term view, this is the best time to invest. There's always a reluctance to buy when markets are low. There's a huge appetite for people to buy when markets are high, but that is in reality a wrong strategy. You should buy when markets are low and sell when markets are high.
Okay, that's a sound advice. Diversify your portfolios. Look at everything. Don't just stay at equities, but also time your investments to when markets are low. Don't lose heart. There will be money-making opportunities going forward. But on that note, completely out of time on this edition of the India Development Debate. Thank you very much, Ajay Srivastava, Saurabh Mukherjee, myself, Nurma, and of course, KK Mistry for joining us. We take a quick breather and we are back with yet another edition of the India Development Debate, where we put the spotlight on politics, because that is going to determine our market trajectory going forward. Mayawati stuns the Congress and goes and ties up with their former Chief Minister, a rebel from the Congress, Ajit Jogi. How is that changing the national political landscape? We come back and tell you all about that with special guests after this very short break.